Bang, 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 bang. This is the Keiser Report. I'm Max Keiser. Yeah, the bond vigilantes are coming into town, and they're blowing away anybody who thought they had safe harbor in the bond market. This is looking like Charles Bronson in that film Death Wish. He's looking for anyone who thought that they had some money parked safely in sovereign debt. They're about to get blown away. Let's bring in Stacy Herbert to get all the gory details, Stacy.
Well, my first headline, Max, sell-off in U.S. Treasuries raises sovereign debt fears. The yield on 10-year Treasuries, which is the benchmark price of global capital, surged 30 basis points in just 2 days last week to over 3.9%, which is the highest level since the Lehman crisis.
Yeah, well, the Lehman crisis was just the first leg of a multiple-leg catastrophe. Please continue.
Well, Alan Greenspan, the former Fed chairman, says that the abrupt move may be, quote, the canary in the coal mine. So he's concerned that this could be about the federal deficit and bond vigilantes' fears of Obama's health care plan, which he says will raise the debt by $1 trillion. But in the Telegraph, they write, there are concerns that Beijing may be sending a coded message before the U.S. Treasury rules next month on whether China is a currency manipulator.
Yes, well, the bond vigilantes blew up Iceland, they blew up Ireland, they blew up Greece, and they stand poised to blow up the United States and Britain. And, of course, one of the big funders of the bond vigilantes is China, which has the capability to apply pressure to the U.S. economy, and we're seeing this happen now. Remember, it's a currency war, and in the fog of currency war, you have to throw away this idea of self-interest, because in a war, anything goes.
Now, that's the bigger picture of the very wealthy nations and what they're doing with their money. Now, the next headline brings me to the individual rich insiders. Rich, stunned by recession, sell munis for first time. So the rich did the unthinkable, they say. They sold municipal bonds.
Yeah, the municipalities. They raise money by selling bonds, and typically they give the rich folks a tax break to buy these bonds. But it's not sufficient to get inducement into these bonds, because people realize that interest rates are about to skyrocket higher, and all bond owners are going to get slaughtered.
Well, but also one of the reasons why the rich put so much money into municipal bonds is because there's a historic 1% default rate. So the rich obviously have the most to lose. They have a lot of savings. Now, they've taken the money out of the municipal bonds for the first time, and they're putting them into U.S. Treasuries. But it takes me to another headline. U.S. Justice Department names J.P. Morgan and UBS as conspirators in U.S. muni bond fraud and bid rigging. So J.P. Morgan Chase and Company, Lehman Brothers, and UBS were among more than a dozen Wall Street firms involved in a conspiracy to pay below interest rates to U.S. state and local governments to investments. Now, this is maybe another reason why the insiders, those in the saloon who scatter once they know the quick draw shows up. They know that a gunfight is about to break out. So maybe they're fleeing for a reason. Maybe there is something they know about these bonds that are sold to the municipalities that other investors might not know.
Well, these Wall Street banks know that muni bond market's rigged. Remember, John Goodfriend at Salomon Brothers a few years back was caught up in a U.S. Treasury market rigging scandal, and the bond market is as rigged as any market, the stock market or the futures market. We just learned last week an insider, a whistleblower, blew the whistle on insider trading and market manipulation on the COMEX, on the silver exchange. So it's no secret that these markets are being manipulated, and the rich realize this, and they're bailing out.
You bring up this case about the insider at the COMEX.
Yes. Tell more details about this. Yes.
Andrew Maguire is the name of the guy, and here's his headline. You don't mess with LBMA, assassination attempt on silver market manipulation whistleblower.
London Bullion Market Association.
That's right. Another headline along the same story, JP Morgan Chase story in UK, i.e. Chase. Well, apparently, Andrew Maguire, who's a metals traders at the London Bullion Market Association, he's a former metals trader for Goldman Sachs. Well, he was just brought up as a whistleblower by GATA, Bill Murphy's GATA. He was testifying before the CFTC, the Commodity Futures Trading Commission, last week about silver market manipulation. And lo and behold, Andrew Maguire, who sent many emails to the CFTC, including one on March 3rd, where he told them on March 5th, watch, I will promise you that the silver market will be taken down because JP Morgan has already signaled to us that they are going to take down the price of silver. And the reason why they want to take down the price of silver, he argues, is that they have this giant short position given to them basically by Bear Stearns. Remember when they took over Bear Stearns? So he calls it not-for-profit selling.
Right. That's right. It's purely for manipulation.
Purely for manipulation. So he said, well, I'm able to read the signals. I'm able to tell that the guy coming in, the quick draw guy, is going to blow away anybody who gets in his way.
Right.
So he was able to front run, and many smaller traders, he said, knows how to do this as well. And they all make money. He makes money off it, but he thinks it's unfair, and it's likely to lead to a giant blow up in the entire market.
Well, you had a whistleblower on Madoff, went to the SEC years in advance, multiple times, and the SEC just refused to act on insider information to stem the Bernie Madoff crisis. Here, the CFTC is acting just as irresponsible as the SEC, and they refuse to act on this whistleblower's facts and figures and proof that there's wide-scale manipulation in the silver market, the COMEX, which, of course, is the antithesis of Tim Geithner, because if silver and gold were allowed to trade freely in the markets, it would take the shine off the fiat currency, dollar, and the complex fractional reserve Ponzi scheming we see all over the world. So it's in their interest to keep the price of metals cheap, to keep their Ponzi schemes going.
The big scandal about this story is in the headline, assassination attempt. So this man's testimony was submitted as evidence on Thursday of last week. Well, this weekend, he and his wife were driving in a car and were hit by a hit-and-run driver who took off. There was a big police chase, helicopters, everything. They captured the guy. The London Metropolitan Police are not giving any further information about the guy they've arrested. But some argue that it's very coincidental that he turns evidence on JP Morgan, where Tony Blair now works, by the way.
Oh, yeah, Tony Blair, who said he didn't go to war for oil, but now works. We find out he's doing millions and millions in deals for oil companies in Iraq. That Tony Blair?
That's right.
Big oil Tony?
But, one other quote I want to read from Andrew Maguire's testimony. He says, as always happens month after month, HSBC and JPM, meaning JP Morgan, sell short in large quantities to overwhelm all bids and make unsuspecting option holders lose their money. Now, this is something that you see across in other markets as well. The options traders are often wiped out by the giant big block buyers.
Right. This is what the high-frequency trading scandal is all about at Goldman Sachs. In other words, on all these markets, there's buyers and sellers, they're market makers, and the price discovery, as it's called, is set by the supply and demand of bids and offers for that particular stock or security. If you're a JP Morgan or a Goldman Sachs and you flood the market with 10 times normal volume, you, in effect, usurp the normal market-making activity, and you set the price in your interests, which, of course, are not the interest of the underlying market. And that's what we're seeing happening all across the board, principally by firms like Goldman Sachs. I mean, they got caught red-handed in the high-frequency trading scandal, manipulating prices on the New York Stock Exchange. And again, the SEC looks the other way. In other words, if you took away fraud from the business model of America, there would be nothing left except porn and donuts.
Well, are you going to be able to take away fraud? Because, okay, so we've covered these stories of UBS and JP Morgan and now the defunct Lehman Brothers involved in this bid rigging and of the municipal bond market. But I'll show you some quick headlines just over the past year. Senior UBS official, meaning Robert Wolf, the CEO of UBS America, key donor, shares some of Obama's downtime. There you see him in this picture. He's playing golf with President Barack Obama. Jamie Dimon, the CEO of JP Morgan, is dining with Barack Obama in the White House tonight. That was just a few weeks ago, at the end of February 2010. So this is the situation where we have this corrupt system with these oligarchs and fast draw guys who have the president who can just exempt them from all sorts of laws.
Right. That's why the healthcare reform issues are really a red herring, because unless you reform banking first, there's no way you can reform healthcare by simply giving the healthcare industry 32 million more customers in which to negotiate deals with the banking system that's systemically corrupt.
We'll next move on to the next headlines of the sort of the global financial system, but also the global empire of America falling apart, and how all these crazy things are emerging from it. Just like during the Great Depression, and we often remind people of what the similarities are to that time. Headline reads, and this is real, "Special relationship is over, MPs say. Now stop calling us America's poodle." To me, they sound more like bunny boilers.
A bunny boiler?
Yeah, you know, the relationship is over. It's been over for 50 years. They've apparently been holding on to this like romantic image that they have some sort of special relationship with America. And now they've decided, all these MPs get together, and let's stop calling it a special relationship.
Look, there is a special relationship. That's where all the toxic waste goes to die in the city of London in their highly corruptible hedge funds.
Well, and a similar headline that goes with this. Netanyahu humiliated after Barack Obama dumped him for dinner. Apparently, according to the article, sources said that Mr. Netanyahu failed to impress Mr. Obama with a flowchart purporting to show that he was not responsible for the timing of announcements of new settlement projects in East Jerusalem. Remember a week or two ago when Joseph Biden showed up, and on that day they announced that they were going to build thousands more new condos in East Jerusalem?
What? What condos? What condos? Netanyahu's become like the Jackie Mason on the world politics. What? Here's a flowchart. I had a condo? No, these aren't condos. This isn't. We had no idea we were going to build condos. I wasn't even in the room. Was I in the room? I never knew. I was in the room. Why are you talking about me? I never knew.
One of the newspapers in Israel said that the prime minister had received, quote, the treatment reserved for the president of Equatorial Guinea. But I thought, just looking at the headlines, as soon as the flowchart came out, perhaps Barack Obama just thought, oh no, it's condo builders now want a bailout. You know, you have headlines of property developers seek bailout, homeowners seek bailout, all sorts of property, car manufacturers.
Condos in Jerusalem, we need a bailout. They call us a bailout? What, I came with a flowchart, I wasn't even in the room. How did I know? Could I know? I didn't know. Look at the flowchart. It couldn't be me. I wasn't even there. What happened? I don't know.
A final little headline to go with Netanyahu and being humiliated and the UK deciding they're not a poodle. Uma Thurman's new film seen by just one person on opening day. I thought they could all commiserate together. Maybe all three of them could go see Uma Thurman's film, which sold one ticket in all of the UK on opening day. It made £9.
All right, much more about Uma Thurman, so don't go away. We'll be right back.
Hungry for the full story? We've got it firsthand. The biggest issues get a human voice, face to face with the newsmakers on RT.
Welcome back to the Keiser Report. I'm Max Keiser. Let's go to Ryan Grimm. Ryan Grimm of the Huffington Post. He has recently wrote a very compelling piece, The New York Fed Warehousing Junk Loans on Its Books. Tell us about what's going on here, Ryan Grimm.
What the Volucas report found is that the New York Fed, that's the regional bank representing New York and a few surrounding areas, had created a lending facility that allowed banks to warehouse was the word that was used, to warehouse these junk bonds and essentially make up whatever they said they were worth. And then when the quarterly filing deadline was over, they would either take them right back, or what they would do is just leave them on the books of the Fed and keep the collateral that they had.
Okay, so the Fed under Timothy Geithner was complicit in accounting fraud.
That's what seems to be the case, but it's definitely not clear how much Timothy Geithner knew, or whether or not these were appropriately valued, or what exactly is going on behind the shroud, because the New York Fed and the Federal Reserve in general doesn't open up its books to any outside accounting or outside auditing. So that was more the thrust of my story, that this shows why there's an audit needed of the Fed, because the only reason that we found out about this is the report that you mentioned, and that only came about because a firm went entirely bankrupt, and then you happen to have somebody overseeing the situation who wanted to spend some serious money and do a real investigation into what happened. That's the only way that we found out what was on the Fed's books. So there might be all sorts of other stuff on the books that we simply just don't know about. You can't even say how fraudulent it was, because you don't know exactly what was happening. You can speculate, and it certainly seems that way, but without getting into the real details, who knows? So it shows that we really ought to be taking a closer look.
Well, yeah, I wrote a piece on Huffington Post myself 2 years ago called "Lehman is Engaging in Peekaboo Accounting." And I mentioned that as the quarters come to a close, they do a swap for cash to make their books look good for the quarterly filing. And then after the quarter is over, they do a swap again, and they bring the debt back to their books. The reason I knew this was going on 2 years ago before this report came out is because, working on Wall Street myself, this is a common tactic used on Wall Street, and to get away with it, at the end of the year, of course, you have to bribe your compliance officer and all these brokerage firms. And I worked on a brokerage in Manhattan, and the biggest firms on Wall Street. Every Christmas, you give the compliance guy a huge bribe money because you're engaging in accounting fraud like this every single day. And the fact that you've got Timothy Geithner and you got the Goldman Sachs guys who are now in government, they're engaging. I can say, based on my own experience, this is just accounting fraud. But the SEC is toothless. The CFTC is toothless. As a matter of fact, if you took accounting fraud out of the U.S. business model, you'd have nothing left. Fraud is the business model, but the economy is going into a death spiral, and we can say goodbye to that entire economy soon enough. So
your story on that was a good one, and it really did foretell, what was coming over the next 6 months to a year. The interesting thing about that is that what you highlight in your story is something that the SEC could actually look into, because they were two private firms that were dealing with each other. I mean, actually, they probably weren't two separate firms. It seemed like they were essentially the same firm. As you pointed out, they were housed in the same building, and the employees were going back and forth. But let's just pretend that they were two separate private firms. That's at least something that regulators can look into. But when you have the New York Fed involved in this case, you have a very bizarre situation, because theoretically the New York Fed are regulators, but they're also a bank owned by banks. And so you have this weird accounting situation where, like you said, these toxic assets are being dumped into this warehouse, which is sort of a regulator. So the SEC can't go looking around in the New York Fed's books. The New York Fed is supposed to be doing that, but they're not going to do it because they're owned by banks. Like you said, it's just a bizarre system.
Right, and of course the New York Fed, tied into the Federal Reserve Bank in Washington, they have access to near infinite credit, and it's a completely opaque institution. And we really have no idea how much debt they have back, behind the scenes. And every time the economy has an uptick, these banks come out and say, oh my God, we have another huge liability on the books that we failed to disclose. And this is happening all over the world, and the result is this huge deflationary problem. Unemployment's rising. How much the bad debt, what's your best guess? It's still yet to be disclosed.
It's got to be just a tremendous amount, because they've been opening themselves up to warehousing this horrible debt for as you said, a long time now. So the Lehman is not the only bank that's going to figure out that they can move their toxic debt over to the Fed. So why wouldn't other banks be doing the exact same thing? And in exchange for real money that's coming back to them. So there's no way of telling, but it could be just an extraordinary amount. Who knows? The New York Fed itself could be effectively insolvent if you actually dug underneath what is there. But then again, it prints its own money for the most part. So the idea of solvency loses some of its rational meaning.
Right. We know that the notional value of the derivatives market is roughly $300 trillion. We know that Wall Street's already gotten bailouts to the tune of 11 to 12 trillion. So there's nothing to say that there could be another 11, 12, 15 trillion or so in toxic debts that have yet to be revealed. And of course, that will precipitate a whole new round of bailouts for Wall Street. So it's quite obscene, actually, because even Barack Obama's prioritization seems to be completely misjudged, because until he solves the banking fraudsters and the accounting fraud and the fraud at the New York Fed and the fraud at the Federal Reserve in Washington, how can he expect any component of the U.S. economy to work like the healthcare industry? Because just by giving the healthcare more money, they do business with the banks, and the banks are hiding their quarterly earnings statements and balance sheets in highly fraudulent ways. So unless he prioritizes this, there's no respite. There's no hope. Now, Alan Grayson, who's a representative in Florida, he points out that the Fed isn't legally allowed to buy these assets. So what's the penalty for breaking the law? Ryan Grimm.
Well, it depends on if laws actually do apply to institutions like this, and it doesn't seem at this point like they do. So the law is also that the Fed is supposed to be reducing unemployment to the greatest extent that it can. That does, are they doing that? That's a pretty clear mandate, but yet the Fed governors project that unemployment is going to remain fairly high over the next several years. Well, why that projection would seem to be in violation of the mandate. So, what are they doing in order to bring unemployment down? And the idea that they're buying assets that are below investment grade does appear to violate the law as they're supposed to operate. So that's got to be one reason that Fed officials are so opposed to having a full independent audit, because who knows what you're going to find after all of these years of the opaque operations of the Fed.
It reminds me of, in the shipping industry, they use these flags of convenience whenever they're shipping huge toxic cargoes of oil. So if, in fact, it runs aground and there's a huge toxic oil spill, then nobody claims ownership of the tanker suddenly. It's registered in one country, it's owned by another country, it's registered in a third country, so nobody actually is responsible for this toxic spill. Here you have bankers running completely out of control who are making fees, hundreds of billions in fees every year, trading trillions of dollars of debt, but when something goes bad, suddenly none of them own any of it. Oh, I don't own it. I never saw it. It wasn't on my books. Oh, we didn't own it. It wasn't here. It wasn't there. It's a complete house of mirrors.
An additional problem that you have over the past year is that policymakers have actually been rewarded for their loosening of accounting standards. As they've gone away from mark-to-market accounting standards, and as they've otherwise kind of liberalized, even from what was even required before. The stock market's rising. The banks are paying back some of their bailout funds, et cetera, et cetera. You're having this at least face value recovery on Wall Street, a lot of which, as you pointed out, is a result of these accounting tricks. And so it only encourages policymakers to continue to push the accounting envelope further. In the House bill, the House Wall Street Reform Bill that passed a few months ago, it actually takes FASB, the accounting board, away from the SEC and puts it underneath a group of systemic bank regulators who can, and this is the word in the regulation is eliminate. They can eliminate accounting standards if applying those accounting standards would pose some type of systemic risk. So, if that passes through the Senate, then the next time that there's some type of panic, then bank regulators could completely legally tell banks, okay, for the next 6 months, forget about it. We're just gonna fudge these books so that we don't have a crisis.
If Al-Qaeda went public on the New York Stock Exchange and did an IPO and floated stock, then everyone would buy into it, and they say, well, we love Al-Qaeda now. That's the only shortcoming of Al-Qaeda is that they're not publicly traded on the New York Stock Exchange. Otherwise, they'd have their own game show. They'd be on TV every day. There'd be commercials. They'd be funding politicians. All right, let's talk about Chris Dodd for a second. He's got his financial reform bill. Is there anything in it that's going to stop the so-called too big to fail banks?
Well, Dodd is saying that the resolution authority would be extremely tough. He compares it to a trip to hell. That if you're a big bank and if you start failing, then the federal government comes in and effectively takes you over, breaks you up, and sells you off. So it doesn't. There are two different frames you can look at it. The first frame being we need to break up the big banks first, before they collapse and destroy everything. The second is when they start to fail, we go in, take them over, break them up, and destroy them at that point, and do it in a fairly orderly process so that it doesn't dismantle the system. The bank lobbyists have succeeded in framing the debate around the second part, that you will keep the too big to fail system in place, but if they fail, then you will take them over and break them up and liquidate them. So, it's not as bad as the current situation. That is, if they fail, you just give them as much money as they need to keep going and let them, loosen their accounting standards, and then, hopefully they can, quote unquote, grow their way out of it. But it's not as good as going in and breaking them up at this point. That frame was never really part of the debate.
Yeah, well, I mean, does it increase or decrease the power of the financial terrorist Federal Reserve Bank?
The original proposal that Dodd came out with in November would have drastically decreased it, would have taken away power from the Federal Reserve in order to regulate banks, and it would have restructured the way that the regional banks staff themselves, at the leadership level. In this time, this proposal expands power for the Fed.
Yeah, wow. Who would have thought that? All right.
Sure.
Ryan Grimm, thanks so much for being on the Keiser Report.
Hey, thanks for having me.
All right, and that's going to do it for this edition of the Keiser Report. I want to thank my guests, Stacy Herbert and Ryan Grimm. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.